In this episode of S&C Critical Insights, Mark Trevino, co-head of S&C's corporate governance practice, outlines the significant developments that emerged from the recent U.S. annual meeting proxy season and discusses governance proposals.
Welcome to our 12th annual proxy season review. We look forward to discussing with you, I think it's fair to say, the unpredictable ride of 2024 and what it means for 2025. Presenting today are Melissa Sawyer, June Hugh, and I'm Mark Trevino. Together, we handle a large variety of the corporate governance matters that Sullivan and Cromwell clients face. And we look forward to sharing some of our experience with you. We're going to talk about the bread and butter proposals, the governance proposals. It's been a while since I've talked about governance proposals because they've been steadily declining, really, over the past 5 years, and that's been the conversation. But this year, they increased by almost 15%. 4 out of 5 of them targeted S&P 500 companies, and there wasn't really an industry focus this year. When you look at the numbers, although submissions are up, voted proposals are down, also by about 15%. That was driven by a high number of successful no action requests. For the proposals that did reach a vote, this category continues to be and always has been since we started the most successful by far, with average shareholder support nearly 3 times that. Other categories of proposals, if we look back, see what the takeaways are, the primary reason for the significant success of these proposals was a return to classic, highly supported structural governance proposals, in particular, the elimination of supermajority voting, which is a shift away from board composition proposals, which also are in this category, and for which shareholder support has been declining. Supermajority voting proposals, uniquely in this category, are a bit more prominent in smaller companies, just because there are relatively fewer larger companies that continue to have supermajority voting requirements. Almost all of the supermajority voting requirements were submitted by John Chevedden. So that's takeaway number 1. Takeaway number 2 is a less successful story, and that's the activity around director resignation bylaws. Over 80% of the S&P 500 have adopted majority voting in uncontested elections, and almost all allow their board to exercise discretion if a director doesn't receive majority support. As we discussed, the Carpenters submitted proposals in this area, 38 out of 43 of them. Their proposals were almost identical, very specific. The provisions should be in a company's bylaws. The board should be required to accept their resignation unless it has identified and discloses in a public securities filing a compelling reason for not accepting the resignation. And it can only do that once, so that if a director loses majority support 2 years in a row, they have to automatically accept the director's resignation. Many of these proposals were excluded through the SEC no action process as a violation of Delaware law. Even where those proposals weren't excluded, the Carpenters, as a result of the no action activity in this area, withdrew them from a number of other companies who had received the proposal but didn't file. Of the 13 that did go to a vote, average support was around 17%, I guess, to be exact. Given that level, which is just not quite high enough to get people's attention, and given the headwinds on legality, it's unclear to me whether proponents will continue to submit similar proposals in this area, even if they can craft one that will withstand no action challenge. We're talking about advance notice bylaws. There was a lot of activity we discussed last year, perhaps as a result of the low support. James McRitchie and his co-filers refashioned their 2023 fair election proposals into 2024 proposals requesting the fair treatment of shareholder nominees. There were 11 of these so far, which would require boards to treat shareholder nominees equitably and to avoid encumbering them with unnecessary administrative or evidentiary requirements. Only one of these actually made it to a vote, with the others being withdrawn after the company agreed to include something in its policies or public disclosures around treating shareholder nominees, quote, fairly. I think we're going to continue be talking about advanced notice bylaws as they're tested in the ordinary course of activism in this coming season later this year. July's Delaware Supreme Court decision does provide some comfort that these provisions are facially enforceable when they're adopted on a clear day, but I think most clients are keeping an eye on this space. There are other cases currently pending that are clear day cases. The outcomes of those decisions could warrant bylaw changes, and depending on what the outcome of those decisions are, could generate activities from plaintiff law firms that regularly highlight corporate inconsistencies and demand fees for their work. So I think it's good to keep an eye on that, and probably helpful to have a record that you're monitoring it in case someone does do you the favor of letting you know about the outcome of the decision. Finally, we really did not see a lot of board composition proposals this year, and in particular, not a lot of independent chair proposals, which were down meaningfully, total down 50%. This has been an ongoing governance dialogue. It's one of the few areas where there's real disagreement among a lot of the large investors, and the outcome has been very fact-specific. Perhaps this is a sign that investors are comfortable that not one size fits all, and perhaps for some companies, an independent chair is the best governance structure, and for others, it's not. But we'll just have to wait until next year to see if that balance stays.
Thank you for listening to S&C Critical Insights. For more information about our practice, please visit us on the web at www.solcrom.com.